So, dear students, how are you? This is your teacher Haris Bhatt, and you are seeing my YouTube channel Learn Accounting with Sir Haris. Today, I'm going to solve the question number 4 of AS Accounting, May-June 2025, variant 22, question number 4. So, I'm going to solve this question for you. And today, I have currently I'm in hill station area, and I used to come here for the recreation purpose, but I decided that I should prepare the video regarding that particular question, which is very important, obviously. So I'm going to start the question. This is May-June 2025. This is a teacher Haris Bhatt. You are seeing YouTube channel Learn Accounting with Haris. So May-June 2025, variant 22, question number 4, right? So I have solved all the 3 questions already, which they are already with you, and you have seen those questions already. And now I'm going to solve the 4th one. So let's start doing this. The first thing is this contribution. M Limited manufactures a single product at one of its factories. The company uses marginal costing. Company uses marginal costing. Define the following terms. The first thing is basically contribution. I've solved company counts question. I have solved the question of errors, which is the second one. I've solved the question of incomplete record or type of a ratio is a simple one. And now the 4th question, which is the most important, marginal costing, May-June 2025-22. Contribution is the amount of profit which contributes towards fixed cost. Contribution is the amount of profit which contributes towards to recover fixed cost, or contribution is equal to selling price minus variable cost. Either it is per unit or it is in total. Fixed cost is a cost which does not change with the change in the volume of production. Fixed cost is a cost which does not change with the change in the volume of production. It remains constant within a certain level of output and then changes after a certain level of output. So total fixed cost does not change with the change in the volume of production up to a certain level of output. Next, total fixed costs remain constant, but per unit fixed cost changes with the change in the level of output. Like rent of building, like line rent of electricity, line rent of telephone bill. These are all fixed costs. Margin of safety is the difference between budgeted sales minus break-even sales. Margin of safety, if you really define it, it is the amount of sales that can be decreased before going into loss, right? The level of sales or amount of sales that can be decreased before going into loss. It is the amount of sales above break-even point, right? Whatever sales you are getting above break-even point, that is margin of safety. The formula is budgeted sales minus break-even sales, or actual sales units, budgeted sales units minus break-even sales units. Let's move forward. Currently, the factory is operating at full capacity of 8,300 units per month. All production is sold. The following details are available about the single product. Selling price 36, direct labor 17, direct material is 8, fixed cost is 6. The directors have a target profit of 35,000 per month. So first of all, you must be very clear about this, that you need to find the contribution per unit, which is 36 minus 17 minus 8, that is going to be 11, right? So 36, minus 17 minus 8, that is going to be 11. Fixed cost is 6 per unit, but always remember that we are working at full capacity, and at any capacity level, any level of output, total fixed cost does not change with the change in the volume of production. So 8,300 multiplied by 6, you will get the fixed cost, which will remain constant. So 8,300 into 6, that is 49,800. So that is the fixed cost. Target profit is 35,000. Let's calculate the current year profit. So current year profit, for that, you need to find the total contribution. That is 8,300 multiplied by contribution per unit, 11, less fixed cost, total fixed cost, which we have already calculated, 49,800. So 8,300 into 11, that is 91,300. So let me write here 91,300. Less fixed cost is 49,800. And if I'm going to subtract it, I will get the profit. That is going to be 91,300 minus 49,800. So answer is 41,500. Okay, now let's move forward. What is the next part of the story? May, June 2025-22, question number 4, not yet available on Cambridge site or anywhere else. Calculate the following in units break-even point. So we have to calculate the break-even point and margin of safety. So remember that break-even point is, the formula for break-even point is total fixed cost divided by contribution per unit. Break-even point is total fixed cost divided by contribution per unit. Total fixed cost, we already have an idea about that because we have calculated that 8,300 multiplied by 6. 6 was the fixed cost per unit. 8,300 is the full capacity. So 49,800 divided by contribution per unit is 11. You will get the break-even point in units. Break-even point in units. That is 4527. 4527. You can round it. That is 0.27. So I have written it 4527. You can round it off. You can take it as 4528 also. That is fine with that. Now you have to calculate the margin of safety. So that is basically the budgeted sales units or actual sales units, because we need to calculate in units form. In units, sorry, actual sales units minus break-even units. So actual sales units are basically, we have already have actual sales units that 8,300 and break-even sales units are 4,527. I'll subtract it. I will get the margin of safety. So 8,300 minus 4,527. The answer is 3,773. So 3,773 will be our, that is the margin of safety. Margin of safety basically sales that actual units sold minus break-even units sold, budgeted sales minus break-even sales. It is the amount of sales above break-even point. It is how much the sales can be decreased before going into loss. Calculate the amount by which the monthly target profit is exceeded. So target profit is 35,000. Sir, how come? Let me show you. It is given in the question when the target profit is 35 and the current year profit, the current profit we are getting by selling 8,300 units is 41,500. It means that we are achieving 6,500 more than the target profit. So that is what he is asking in the question. Calculate the amount by which the monthly target profit is exceeded. So we can now do that easily, right? 41,500 minus 35,000. So by 6,500, the target profit is exceeded. With the $6,500, the target profit is exceeded, means that we are getting more amount of profit, 6,500 more amount of profit than what is required by our target profit. Let's move forward. A part of the question has already completed, and I think that you are done with that easily, right? So at a second factory, two products are currently being made, product X and product Y. The following budgeted information is available. Let me wrap it up now so that you can do it easily. So selling price per unit, product X, we are producing two products, X and Y. Selling price per unit is $40. Direct material per unit is 14. For Y is 38 and 15. Direct labor per unit is 1.5 hours at $8 per hour. Monthly capacity 14,000 units for product X and 4,000 units for product Y. Monthly output and sales are 85% of capacity, right? And 100% of capacity for product Y. It means that we are selling 4,000 units of product Y and we are selling not 14,000 units of product X. We are selling 14,000, which is the monthly capacity, into 85%. Currently, we are selling at 85% of capacity. So if you calculate it, it is 11,900 units. So it means that 11,900 units are basically produced and sold for product X and 4,000 units of product Y. The factory fixed cost per month are 1,26,000. This is the total fixed cost, which does not change with the change in the volume of production. And it is the total fixed cost per month for both product X and Y. It means that we are going for a monthly target profit. We are going for the option 1 and option 2, in which we have to calculate profit for on monthly basis. Number 1. Number 2 is this, that as you know, that the fixed cost is combined. It means that both for product X and product Y, fixed cost will remain the same. For example, if I will drop manufacturing product Y, if I will drop buying and selling product Y, the fixed cost in total 1,26,000 will not change. It will remain the same. There is no change in fixed cost. So let's move forward. The directors are aware that an overseas supplier could provide product Y, resulting in a contribution to M Limited of $17 per unit. So directors has come to know that an overseas supplier could provide product Y, resulting in a contribution to M Limited of $17 per unit. It means that we are not buying product Y, and we are buying and selling product Y, and out of that means that after subtracting variable costs from the selling price, from the buying price, buying costs from the selling price, we are getting a contribution per unit of 17. It is already given. But the overseas supplier, here it is written, can supply 3,000 units per month. So it is understood that if we are not buy and sell product Y as we were doing in the past regarding 4,000 units, now we can purchase Y and sell Y by purchasing it from an overseas supplier, and from that we are able to sell only 3,000 units per month, and the contribution per unit is 17. So if you multiply 17 into 3, so it is clearly mentioned, it understood that 3,000 into 17. So if we purchase the Y from outside supplier and sell it, we have a contribution of 51,000. Fixed cost will remain the same, because fixed cost, either we buy previously whatever from where we are buying, local supplier, or we are going to buy from an overseas supplier, fixed costs will remain for the two product, which is 1,26,000. So let's find out that what is the contribution we are getting currently from Y. So let me calculate. Direct material is 15. Then labor is 1.25 hour into 8. That is going to be 10. So labor is 8, 10, and 38 minus 15 minus 10. So contribution per unit is 13. Contribution per unit is 13 previously, 4,000 into 13. So the total contribution we were getting from the local supplier by purchasing Y from the local supplier and selling it, we were getting the contribution of 52,000. But if we are going to buy the Y product from an overseas supplier, we are going to get a contribution of 51,000. So 1,000 less, that's it. But we are going to achieve some more benefit out of that. Because directly he's saying that if we purchase from overseas supplier, at what price we sell, we don't know. At what price we buy, we don't know. But we are going to get a contribution of 17, and we are able to sell 3,000 units. So 3,000 into 17, 51,000 contribution we are getting. And previously we were selling 4,000 units, and the contribution we were getting is 52,000, because the contribution per unit were not that high in the past. Now it is 17, it was 13 in the past. So what will the benefit we are getting out of it? That now we are getting almost the same contribution, but we are selling 1,000 units less of Y. So we have material availability more. We have labor, which will be redundant or abundant for 1,000 units, which we'll have and we'll utilize that. So now the directors are considering two options. Option A, continue with the production and sales of both product X and Y as now. The way you are producing product X and Y, continue with that and find the profit with option A. Option B, stop production of product Y, stop producing product Y, and buy in 3,000 units from the overseas supplier. So it means that we are producing product Y first. Both products we are producing actually. Being made, yes. So now you can consider it make or buy decision. So we are producing it at a variable cost of direct material, direct labor is given. So the material we are purchasing from an overseas supplier, whatever. But now we are going to purchase product Y from an overseas supplier that is the finished product. And because of that, we are getting a contribution. We are selling 3,000 units and getting a contribution 51,000. So first of all, he is not considering that. He said that continue with the production and sales of both product and Y, produce it and sell it. And let's see what profit we are going to get. Option B, stop production Y and buy it, 3,000 units from an overseas supplier. And because of that, there is going to be a change in the question. So prepare a marginal cost statement for option A to show the total monthly profit being made, and prepare the marginal cost statement for option B to show the total monthly profit for option B. So let's calculate the total monthly profit for option A first. Let me calculate it for you. So for X, for Y, I will go for the total, I will go for the contribution. So what is going to be the contribution? Yes, I can go for the sales amount, the variable cost. Sales minus variable cost will get contribution, but we can calculate it easily. Right? Why, sir? Let me show you. The selling price is 40. 14 is the, for X, direct material per unit is 14. 1.5 into 8, that will come 12. Let me calculate it. 1.5 into 8, that is going to be 12. So 14 is direct material, 12 is going to be the direct labor, and 40 is the selling price. So let me calculate it. 40 minus 14 minus 12 will get the contribution per unit. 40 minus 14 minus 12, that is 14 is going to be the contribution per unit for product X. For product Y, we have already calculated, but I will calculate it again for you. 15 is the direct material per unit. 1.25 into 8 is going to be the direct labor per unit, that is 10. So 38 minus 15 minus 10, 38 minus 15 minus 10, we will get the contribution per unit of 13. So let's calculate the total contribution for these units. For X, let's see how much units we are producing and selling. Monthly capacity is 14,000, but we are selling only 85% of capacity. So 14,000 into 85%, we have calculated, that is 11,900 into contribution per unit, that is 14. For product Y, we are selling how many units? Let me show you. 4,000 units into contribution per unit, that is 13. And I have already calculated that, that is 52,000. Now 11,900 into 14, that is 1,66,600. So the contribution for product X is 1,66,600. Let's find the total contribution for both products. That is going to be 1,66,600 plus 52,000. 218,600. So the total contribution is going to be 218,600. Now I will subtract less fixed cost. Fixed cost is same for both the products in total. So let's see, it is given 1,26,000. How comes that? I will show you later on. So I will subtract the total contribution. I will subtract fixed cost from the total contribution, minus 126,000. So the profit is 92,600. So from option A, we are getting a profit of 92,600, in which we are able to produce both products for the month actually. This is the calculation for the monthly calculation. So any problem? We are done with the first part of option A. First, we have calculated break-even. It's a different question than margin of safety. Then the target profit is exceeded by 6,500. Finished. Then the other part, that at a second factory, we are producing two products, X and Y. He has given two options that continue with the X and Y. So I have calculated the contribution per unit. I have multiplied it with the 85% of capacity for product X, 11,900 into the contribution per unit. I will get total contribution 166,600. Then I have been producing also Y, 4,000 units, 100% capacity into 13, which is the contribution per unit, 38 minus 15 minus 10 into 13 for 52,000. Total contribution for both product is 218,600 minus fixed cost. In total, there is written 126,000. So we have a profit of 92,600. Now let's go for the other part of the story. which is option 2, which states that stop manufacturing product Y. So you are supposed to manufacture only product X now. Let's discuss that. Stop manufacturing product Y and buy in 3,000 units from the overseas supplier. So it means that you are getting Y from overseas supplier now. So Y you are getting from overseas supplier, and you are getting a contribution obviously from Y, direct contribution from Y, which is 3,000. I'm talking about Y into 17. It is clearly written, which is 51,000. So Y is giving you 51,000 contribution now. And let's talk about X. If we talk about X, oh, the question states that most direct labor currently making product Y, whatever labor was producing product Y now is available, would be used to make additional units of product X so that output reaches full capacity. Now you are producing product X, but the capacity has now been reached to full. We were producing full capacity means that we were basically producing 11,900 units. Now we can produce 14,000 units of product X. So 14,000 multiplied by selling price. Let me calculate. Selling price of product X is 40. So 14,000 into 40. Yeah. If you want to prepare a full-fledged statement for option 1 also for X and Y, you can do that also. It is not necessary that you can do a small working. You can calculate it wholeheartedly in full swing, and it is completely up to you. So that is going to be 5,60,000. Now I will subtract less variable cost. So then why you are showing it now and you didn't show it earlier? Because there is a change in the variable cost portion. So I have to record the change accordingly. So that is why I have no choice to do it in that way. Number 1, I'm using the abbreviation. I'm not writing the full-fledged version like labeling. So you have to go for the full labeling. Remember that it has marks, right? But just to cut my, time short, I'm doing it. Okay. Then most direct labor could make product Y would be used to make additional units of product S so that output reaches full capacity. Now we are producing full 14,000 units of product X, which we are doing. So we are done with that. Now, to sell all output of product X, the selling price of all units of product X would be reduced by 2.5%. Oh my God. So it means that I can't multiply it with 40. Why, sir? So let me rub it. It is possible that you can write it wrong and then you can have to do it again. It's not a big deal. It's quite easy because the selling price is 40. Now we are going to reduce it because we are selling, full units. So 40, 2.5%, 40 into 2.5%, that is 1. 40 into 2.5%, that is 1. So now we are selling 100% units, which is 14,000, but the selling price is going to be 39. Yes. So let's talk about the sales. 14,000 into 39, that is 5,46,000. So the sales for product X is going to be 5,46,000. Let's move forward now. The directors will negotiate an increase in trade discount from 20% to 25% on all purchases of direct material for product X. So we were getting a trade discount of 20%. Now the trade discount will increase to 25%. Why? Because we are purchasing in bulk. We are producing 11,900 units. We are getting material for 11,900 units. Now we are producing 14,000 units. So we will be ready to purchase more material from the same supplier. So that's why now he is going to give us a discount of how much? 25%. So this 14%, 14 direct material per unit is 14. That is after a discount of 20%. So this 14 is equal to 80% of direct material value. This 14 is basically direct material price 20% after subtraction of 20%. So 14 is basically 80% of the direct material price, which was before the discount of 20%. So 14 divided by 0.8, so the amount is going to be 17.5. So 17.5 was our direct material price. And now if you give a discount of 20% on this amount, you will get 14. Check it out. But now the discount has been increased to 25%. So the trade discount is now 17.5 multiplied by 25%, because it has been increased, because now we are purchasing in bulk. We are purchasing more. So 17.5 into 0.25, that is 4.375. 4.375. Now I can subtract it, get my direct material price, new direct material price, 17.5 into, 17.5 minus 4.375. You can find 75% also. It's up to you. 13.125 is going to be the direct material price from now onwards, after getting a discount of 25%. Now let's move forward. So we are going to go for a direct material cost, that is 14,000 multiplied by 13.175. Let me calculate it. 14,000 into 13.175. Let me 13.125, I think so. Let me show you just a minute if I'm going for the wrong calculation. Yeah, 13.125. So now 14,000, I hope you are getting it, into 13.125, that is 183,750. So 183,750 is going to be the direct material price. Now let's talk about the direct labor. Obviously, there has to be change in direct labor also. Direct labor currently producing product Y would require retraining at a cost of $5,000 to be written off at the start of the month of operation, first month of operation. So this is an increase in the fixed cost. Okay, that is training cost will increase. Then the machinery currently working used for production, product Y, has a carrying value of 23,000 and would be written off at the start of the first month of operation. This is again a fixed cost, because the machinery is now, as a carrying value, is now going to be written off at the start of the first month. Although it has a carrying value of 23, this is again a fixed cost, because we have a loss of non-current asset, because will be now redundant, or it will not be used anymore. So that will be, a loss for the firm, especially for the start of the first month of operation. So these two fixed costs will increase 5,000 and 23,000 in the total fixed cost. So let's move forward. For direct labor, there is no change in direct labor price. So let me see the direct labor price for product X. Direct labor is 1.5 into 8, that is 12. So 14,000 into 12 is the direct labor, which is not changed at all. So let me calculate. Yeah, we are producing 14,000 units now, my dear, not 11,900. That is 168,000. Now let me go for the total. I will go for the total of the variable cost, because we have to use the contribution approach. And then what I will do, I will go for the contribution. Let me go for the total, 183,750 plus 168,000. The answer is going to be 351,750. So let me write here 351,750. So now I will subtract less variable cost, बल्कि इसको आगे कर लें थोड़ा सा. So 546,000 minus 351,750. 546,000 minus 351,750. The answer is 194,250. That is going to be the contribution. 194,250. 194,250. So I'll get the total contribution, rather the contribution we have for X. So now I can write here also the contribution for X is 194,250. Let me go for the total contribution for both of them. I will write here total contribution, that is 194,250 plus 51,000, because we are getting a contribution of Y by purchasing from an outside supplier and directly selling it. 245,250 rather than producing it. I can write here 245,250. Now I have to subtract less fixed cost. There is a normal fixed cost which will remain the same. There is no change in that. And the amount is going to be 1 lakh 26,000. But there is a change of two amounts, that is training cost, which is increased, and the machinery written off cost of 23,000. I can write here training cost and machine written off, which is going to be increase in fixed cost of 28,000. So I can write here 126,000, then 5,000, and then 23,000. Let me subtract all of them, and then you will get the profit for the year. So 245,250 minus 126,000 minus 5,000 minus 23,000, you will get a profit of 91,250. So you can easily assess that the profit you are getting 91,250 is less than the profit you are getting in option 1 through the normal way, right? So you are getting more profit 92600 minus 91250. So 1350 profit is more by 1350 in option 1. Remember this, that I didn't prepare the proper marginal cost statement, right? You need to prepare a proper marginal cost statement, because prepare a marginal cost statement for option A to show the total monthly profit being made, and for option 2 also calculate the total profit made in the first month of operation if option B is adopted. So we are done with that. So here I have gone for a marginal cost statement, but you can go for a marginal cost statement like you will write sales. I didn't do that because I don't feel that it is required currently, especially in the video. You will write sales for X and Y. You will write less variable cost. For both, you will find contribution. For both, total contribution, less fixed cost. But this also can be considered as marginal cost treatment, right? It doesn't mean that you will start from it. So he is eligible to subtract the mass, because I have prepared in a proper marginal cost statement format. So we are done with that. Just we have found the contribution directly, which is already given, like 14 for X and 13 for Y. That is sales minus variable cost. Okay. So one profit is more in option A by 1350. So advise the director which option they should choose. Justify answer by discussing both financial and non-financial factors. First of all, financial factor is clearly stated that your profit in option A is more than option B by 1350. Then in option A, our fixed cost does not change, but in option B, our fixed cost is increased by 5,000 because of training and because of machine written off cost, right? We have to train the, maybe the training cost will increase more in the future because that is the first month, and maybe we have to go for more training cost, which will increase our fixed cost continuously. Secondly, these two fixed cost is only for the first month. In future, these costs might not be incurred, so the profit will increase in future. Secondly, we have to see that whatever contribution we are getting by purchasing in option B, whatever contribution we are getting by purchasing Y from an outside supplier, do we think that he's able to give us the same quality of material, same quality of product, which satisfy the customer? Customer might not feel satisfied in the future, and our contribution will decrease, our profit will decrease in the future. Although we are getting more contribution per unit of 17 rather than 13, and we are selling less units. So it is also possible that customers of Y, will be dissatisfied because we are not able to provide 1,000 units. And if there is a complementary goods, then obviously it will affect the sale of X also. So X units might decrease because customer will feel dissatisfied and they will move to our competitors. So we have to see the reaction of competitors. And when the labor, so okay, labor will not be redundant because the whole labor will be transferred for the production of product X. Then we are getting, in option B, we are getting, more material discount, and we are able to sell 100% capacity also for product X. Previously, we were selling 85% capacity only for product X. There is not much difference in the contribution, right? So we have to see that either the customers, suppliers, what reaction they are getting. Secondly, that maybe it is possible that when we will not produce product Y, then our sale of product X will also hamper, because some people who are purchasing product Y, they were also purchasing product X, side by side. So they will feel the joy. Secondly, when product Y will not be anymore, then maybe the employees who are able to produce product Y, maybe they will be redundant or they will feel demotivated. Even they are transferred to for the production of product X, that it might be possible that company can stop producing product X also if they are not getting good heavy amount of profits. So then we have to see the delivery cost, the from the overseas supplier, that what cost we are going to incur. It might increase in the future because currently we are not incurring any delivery cost, because he might be the supplier might be paying the delivery cost on his own. That's why we are getting contribution of 17 more than we are getting in the past by producing Y, which is at a price of 13. So quality can be compromised, right, for option B. So, and if we are seeing that either the supplier can be able to give us the same quality on a continuous basis or only for a month. So if the supplier is, our relation with the supplier is good, overseas supplier, and he can give us continuous supply, then we can proceed for option B, because we believe that the training and machine return of costs will incur only this time. So our profit will obviously increase in future for the for option B, right? So obviously option B in that case is going to be a better choice, irrespective other than this, because of the reason that we are getting more material discount, number one, for product X also, and we are not we are not supposed to hire people for the production of product Y and X both, right? But in in option one, we are basically going for the same scenario which we were going in the past. So profit is definitely 92,600, which is 1350 more than the previous profit. But I believe that in decision making, we should go for option B because it has more prospects in the future. It might be possible that we can start selling product, to an overseas customer, because we are buying the product Y. We can sell product X to the overseas customer, start selling the product to overseas customer. That is also a possibility. Then we know that our product X is more important because product X is giving us the major chunk of our profit. So making product X more, it means that we are able to sell more units of product and it is more in demand. So it might be possible that if we go for option B, if you go for option A, the product Y demand will decrease more and more in future. So purchasing it from an outside supplier is more comfortable. So I'll go with option B. So this is the end of the topic, this question. I hope you are able to understand it. Thank you very much. May June 25, 22, question number 4. We are done with that. And I'm happy that you are with me. And please subscribe my channel. Learn Accounting with Sir Haris. Follow me on Instagram and Facebook. Feel free to ask me any question. 0333471287. And inshallah, as soon as I will get the more papers, I will upload it. And the most important thing, ready for the guess of October, November. If any teacher can give, please upload the video for your guess so that I can learn from you and I'll take help from that particular portion. If you talk about this particular question, because it is just sliding, unfortunately. So this question basically wants us to go for a sale ledger control account. It is quite easy that we have to prepare a sale ledger control account. So this is quite simple. It's not that difficult. Simple sale ledger control account. Then security of data. This is the theoretical part. That state three ways in which the security of data can be ensured while a computerized accounting system. You can go out a password, proper password. It should be changed accordingly. No one should know about the password. Then you can go for a firewall so that no virus scan should be installed. Firewall should be installed. So that would be a better thing for the security of your data. So computerized accounting is basically used for that particular sense. Then keep a backup also for the data, because backup is very important. But if the data lost because of virus or something else happened to your system, you should have a secure pathway to solve to get the data back. So security of data can be prepared, that you should have a backup also. Firewall can be installed, as I discussed with you. Proper password, limited access to the people. Only one person should access the data, so that should not be any manipulation in the data. So this is how we are done with this question, and hopefully I will continue putting videos on my YouTube channel. Thank you very much. Feel free to ask any question. Take care. Allah Hafiz. God bless you all.